Welcome to our lecture on corporate governance, agency conflicts, and executive compensation. Our central question is simple. How do governance systems shape managerial incentives and protect responsible value creation? Corporate governance is sometimes treated as a legal or boardroom subject. In finance, however, it is much more. A firm uses capital supplied by shareholders, creditors, employees, suppliers, customers, and other stakeholders. Managers decide how that capital is invested, financed, and protected. Governance determines who has decision rights, who monitors those decisions, how managers are rewarded, and what happens when decisions destroy value. Its mechanisms include boards, shareholder rights, disclosure, internal controls, audits, debt covenants, legal duties, compensation systems, and market discipline. The valuation framework shown behind me gives us the financial connection. Governance can improve expected cash flows by supporting better capital allocation, limiting waste, and discouraging self-dealing. It can also reduce perceived risk by strengthening reporting, accountability, and investor confidence. Strong governance does not guarantee that every decision will succeed. It creates conditions in which sound decisions are more likely to be identified, challenged, approved, monitored, and corrected. Think of governance as the system that protects the link between managerial action and long-term firm value. In many corporations, the people who own the firm are not the people who manage it. Shareholders provide equity capital and receive the cash flows remaining after other claims are paid, while professional managers make operating, investment, financing, and strategic decisions. This separation can create real value. Managers may bring specialized knowledge, industry experience, and the ability to coordinate a complex organization. But it also creates an incentive problem. Managers may not always choose the action that owners would choose if the owners could manage the firm directly. The reasons are easy to understand. Managers may care about compensation, job security, status, control, reputation, or convenience. They usually know more about the firm than outside investors. Their careers and personal wealth may be concentrated in one company, while shareholders can diversify. They may also have a different time horizon. This is the agency conflict. An agent is expected to act for a principal, but their interests are not perfectly aligned. The agency cost framework shown behind me separates the cost into monitoring, bonding, and residual loss. Monitoring means observing and reviewing managerial behavior. Bonding means creating credible commitments through disclosures, covenants, or compensation restrictions. Residual loss is the value still lost when imperfect alignment remains. Governance aims to reduce the total cost without eliminating the discretion managers need to do their jobs. Agency conflicts extend far beyond a simple disagreement between executives and shareholders. First, managers and shareholders may conflict when managers pursue private benefits, empire building, entrenchment, or low-effort strategies. Capital may then be directed toward choices that increase managerial comfort or influence rather than firm value. Second, shareholders and creditors can prefer different levels of risk. After debt is issued, equity holders may favor strategies with greater upside because creditors share part of the downside. Covenants, collateral, and monitoring help control this tension, but they can also reduce flexibility. Third, controlling shareholders may use their influence in ways that benefit themselves at the expense of minority investors. Weak minority protections can therefore lead investors to apply a valuation discount. Fourth, short-term investors and long-term investors may disagree about the timing of value creation. Pressure for immediate results can weaken investment in research, maintenance, people, customer relationships, or risk controls. Managerial discretion can also create value leakage. Common forms include unnecessary expansion, personal perks, actions that make management difficult to replace, excessive caution, excessive risk-taking, and earnings management. The lesson is not to remove discretion. Managers must respond to uncertainty and changing conditions. The goal is to place discretion inside a system of transparent reporting, informed challenge, and meaningful consequences. The board of directors is a central governance mechanism. It does not normally run daily operations. Its role is to oversee management, approve major decisions, monitor performance, evaluate senior executives, and represent the interests of shareholders and the corporation as a whole. Board oversight is especially important when a decision is large, hard to reverse, or likely to change the firm's risk profile. This includes acquisitions, major financing choices, payout policy changes, restructuring, large capital projects, executive appointments, related party transactions, and major risk policy changes. Different board committees focus on different questions. The Audit Committee examines reporting, controls, and disclosure quality. The Compensation Committee asks whether pay rewards sustainable performance. A Risk Committee reviews leverage, liquidity, operating, legal, and reputational exposures. The Nominating and Governance Committee considers board structure, expertise, and independence. Each mechanism has limits. Accurate accounting does not guarantee a sound strategy. Incentive measures can be incomplete or manipulated. Rare risks can be underestimated. Formal independence can exist without active challenge. That is why independence is necessary but not sufficient. Effective directors also need expertise, timely information, preparation, appropriate incentives, and a culture that welcomes constructive disagreement. A strong board does not approve a decision after management is already committed. It provides informed scrutiny before major capital is placed at risk. Shareholders influence governance through voting, director elections, say-on-pay votes, proposals, direct engagement, litigation, public campaigns, and sometimes takeover activity. These rights allow investors to respond when they believe management or the board is failing to protect value. Shareholder activism is a more active form of that influence. An activist may call for changes in strategy, leadership, governance, capital structure, payout policy, or operations. The argument may be that the firm is underperforming, holding excess cash, investing in weak projects, using an inefficient financing mix, or failing to realize the value of its assets. Activism can improve value by exposing poor capital allocation, strengthening accountability, or challenging entrenched management. But activism can also create costs when it pushes the company toward immediate stock price effects at the expense of long-term investment and resilience. A demand for higher payouts may return unused cash, yet reduce flexibility. Selling a division may sharpen focus, yet sacrifice strategic options. Replacing leaders may restore accountability, yet create disruption. Using more debt may impose discipline, yet raise distress risk. Redesigning executive pay may improve alignment, yet overemphasize easy-to-measure targets. So activism is not automatically good or bad. The proper finance question is whether the proposed change improves long-term risk-adjusted value after considering strategy, financing constraints, implementation risk, stakeholder effects, and lost flexibility. Executive compensation is one of the most visible tools for aligning managers with the firm. A well-designed package should attract and retain capable leaders, motivate effort, encourage sound risk-taking, reward genuine value creation, and discourage manipulation or self-serving behavior. The compensation structure shown behind me includes fixed pay, annual incentives, equity-based awards, benefits, and other forms of compensation. The central governance question is not simply how much an executive receives, it is what behavior the package rewards. Pay for performance sensitivity describes how strongly an executive's wealth responds to changes in firm value. Greater sensitivity can improve alignment because managers share more directly in the consequences of performance. But greater sensitivity also concentrates personal wealth in the company and may encourage choices that maximize the compensation payoff rather than total firm value. Compensation design therefore requires careful questions. Which performance measures are used? Do they reflect cash flow, capital requirements, risk, and long-term economics? Is the measurement horizon long enough? Are results judged against absolute goals, peers, or growth? Does the plan reward growth even when that growth fails to earn an adequate return? Are there meaningful consequences for misconduct, excessive risk, unsustainable performance, or later restatements? Good compensation design is not a search for the strongest incentive. It is a search for the right combination of motivation, risk control, time horizon, and accountability. Performance metrics translate strategy into managerial incentives. Once a target enters a compensation plan, managers naturally pay attention to it. The danger is that they may optimize the measure instead of improving the business. Revenue growth can encourage expansion, market share, and customer acquisition, yet growth may destroy value when it fails to cover operating costs and capital needs. Earnings per share can focus attention on profitability and shareholders, but it may also encourage repurchases, accounting choices, or cost cuts that improve the reported figure without strengthening economic value. EBITDA highlights selected operating performance, but it can understate the importance of capital intensity, depreciation, taxes, and working capital requirements. Return on invested capital encourages efficient use of capital. Its weakness is that managers may reject long-term investments that temporarily reduce current returns, even when those investments create value. Stock price and total shareholder return connect compensation to investors. However, market-wide movements may reward or punish executives for forces outside their control, and short measurement periods may encourage short-termism. Strategic milestones can support innovation, integration, safety, quality, or transformation. Yet they involve judgment and may reward activity rather than results. No single metric is complete. Strong plans combine measures, use a multi-year perspective, adjust for risk, and preserve board judgment when unusual events distort the signal. Equity compensation is intended to make executives think more like owners, but different equity instruments create different incentives. Restricted stock gives an executive actual shares that vest over time or after conditions are met. Its value generally rises and falls with the share price. Because the executive participates in both upside and downside, restricted stock can support a broader ownership perspective. Stock options provide value when the share price rises above the exercise price, while the option itself does not create a negative payoff when the share price falls below that level. This shape creates strong upside motivation, but it may also encourage greater risk-taking. A strategy with a limited chance of a very large gain can look attractive to an option-heavy executive, even when diversified shareholders would prefer a more valuable, less distorted choice. Performance shares vest only when selected conditions are achieved. Those conditions may involve market returns, earnings, cash flow, capital efficiency, strategic progress, or performance relative to peers. Their usefulness depends on the quality of the chosen conditions. Equity compensation is therefore not automatically aligned with value creation. The result depends on the payoff shape, vesting period, performance requirements, holding rules, and treatment of downside outcomes. Governance responses include combining instruments, requiring continued share ownership, using risk-adjusted measures, reviewing major changes in risk, and applying clawbacks when reported success later proves unsustainable, misstated, or linked to misconduct. Short-termism occurs when managers place too much weight on near-term targets and too little weight on long-term value. It can arise from compensation plans, investor pressure, career concerns, debt covenants, analyst expectations, or internal budgets. It may appear as delayed maintenance, cuts to research or employee development, weaker cybersecurity, aggressive sales terms, underinvestment in long-horizon projects, repurchases that displace attractive investment, or excessive leverage used to fund payouts. The problem is not that current performance is unimportant. Current results provide information about execution, liquidity, and strategic progress. The problem begins when the metric becomes the objective, rather than a signal of underlying economics. Governance must also guard against the opposite distortion, excessive conservatism. Managers whose careers and wealth are tied to one firm may avoid valuable projects because failure would be personally visible. The goal is not to eliminate risk, but to distinguish good risk from bad risk. Good risk is understood, priced, financed, monitored, and connected to a credible strategy. Bad risk is hidden, poorly measured, incentive-driven, or large enough to threaten the firm without adequate reward. Warning signs include optimistic forecasts without serious downside analysis, rising compensation beside weakening cash flow quality, complex adjustments, unexplained related party transactions, turnover in control functions, weak board materials, dominant executives, fragile liquidity, and a culture that rewards hitting targets more than truthful reporting. Let's finish with a practical governance lens for financial decisions. Before approving a major action, ask who benefits if it succeeds and who bears the downside if it fails. What measure will define success? And does that measure capture cash flow, risk, capital needs, and long-term effects? What assumptions, timing choices, accounting treatments, or benchmarks could be manipulated? Which realistic alternatives were rejected? What information does the board need? And what future evidence would trigger a review or change in direction? These questions turn governance from an abstract idea into a decision discipline. A proposal can appear financially attractive while still being shaped by poor incentives, incomplete information, transferred risk, or weak accountability. Good governance also requires balance. Too little oversight allows private benefits, hidden risk, and poor capital allocation. Too much oversight creates delay, bureaucracy, and fear of initiative. Effective oversight gives capable managers room to act, while requiring analysis, transparency, challenge, and responsibility for outcomes. Responsible value creation requires both trust and verification. The strongest systems combine informed boards, credible reporting, shareholder rights, sound compensation design, risk controls, ethical culture, and market discipline. The central message is this: governance shapes behavior before decisions are made. When incentives, information, authority, and accountability work together, responsible value creation becomes more likely. Thank you for joining me today. I'll see you in the next video.